one more thing. We have the capability of muting the whole audience so that you all can't hear each other with your background noise and all, but towards the end, we're going to unmute and then have anybody that has any questions to be able to ask them. And when we do that, we're going to ask you to mute your own phones so that we won't be overlapping over each other. So let me introduce Winters. Winters Rich Wine is Cornerstone COO. He's one of the partners of the firm. There are 3 partners now of Cornerstone. Winters has got all these credentials. I like to tell people when we have guests that I have to go borrow some of the plaques that he has on his wall to put on my wall. He's an MBA, he's a CPA, he's also a CFA, which is probably the more difficult thing that some of the folks around here have. And so I'm going to turn it over to Winters, and it's going to be good. So thank you all for joining us. And so here's Winters.
Well, hello everybody, and Ray, thanks for the kind introduction. So as Ray mentioned, this is the first in a series, and really the thought of doing this one first was that taxation elements are kind of foundational for a lot of plan giving. So if you came expecting a presentation on taxation, great, you're in the right place. If not, I think you will be sorely disappointed, unfortunately. However, we will try to make this tax material painless to the extent we can, and I think it's got a lot of great concepts here that you can use as you're working with donors. So what we plan to do for the rest of this series will be cover modules generally revolving around material created by Dr. Russell James, who's one of the leading plan giving experts in the country. This particular presentation is really based on our own material, but as we talk about taxation, it really is a motivator for giving, and in particular for plan giving. So of course, we all look for donors, and a big motivation for giving is because we really believe in the cause of the organization that we're giving to. And in the case of the organizations we work with, we want to get money into ministry for kingdom purposes. However, Dr. James' research has shown that when you talk about giving, in particular plan giving, and you use language like tax deductible, saving on taxes, it is really influential in driving gifts. And so what we want to do with this particular module is arm everyone with that type of knowledge around personal taxation, such that as you're talking to donors, you really can help pull those levers and give donors extra incentives to make gifts, even beyond them really caring about your organization and its mission. So here's what we plan on talking about today in this module. We've got an introduction to the new Tax Act. So a lot about personal income taxation has changed for 2018. I think many people are aware of that generally, but I also think that it's going to really hit home for people when they file their taxes for 2018. Of course, that'll take place in early 2019. So we want to look at some of the changes and how that might influence giving and plan giving specifically as well. So following that, we'll talk about income tax, which is, of course, one of the main areas of tax that individuals face. We'll next cover capital gains tax, essentially when folks are selling assets, what tax do they pay there? We'll talk about estate tax. So there are tax implications that come from passing away, and we'll look at that. And then finally, as time allows, we'll look at tax aspects of investment accounts. There are some particular types of investment accounts that we believe are really good ones to donate for some reasons that we'll cover later in this module. So we've blocked off for this particular session an hour and a half. We've got a good number of slides to cover, but typically we'll move through the slides pretty quickly. And I think for the most part, we'll be able to cover this shorter than that window that we blocked off. In terms of questions, there's a chat function within the GoToMeeting application. So what we'll try to do is once we finish the materials, just to make sure we stay on track, we'll look at that list of chat items, and so we'll try to address questions as time allows. I think from there, let's dig in. Let me give you all a reminder that we are being recorded, so this can be distributed to other folks. And I think let's dive in. So when we talk about tax, let's first define what tax is. So to get this, we looked in the dictionary. So the leading dictionary definition is a sum of money demanded by a government for its support or for specific facilities or services levied upon incomes, property, sales, etc. So I would describe that definition as accurate and perhaps a little bit verbose as well. There is a secondary definition for tax that I think we'll all relate much more closely to. That secondary definition is a burdensome charge, obligation, duty, or demand. So I think that's really how we feel taxes for the most part. And you know, one of the great things about charitable giving is that it allows us to avoid some of those burdensome charges. So individuals pay 5 primary types of tax. The first is income tax. So as we work in our careers, we earn income. That's taxed. If we have investments that generate interest and dividends, that's taxed as well. If we have, say, rental properties that produce income, all of those things are income tax. A secondary type of tax that we pay is sales tax. So when we buy an item, whether that's a pack of gum or a car, there's a tax that the selling party has to collect, but of course, we as the buyer essentially pay that. The third type of tax is capital gains. So if we buy an asset and then we sell it for more than what we paid for it originally with some adjustments, then we have to pay capital gains tax there. The fourth type of tax is property tax. And property tax is usually assessed as a percentage of a value. So we typically think about paying property taxes on items like houses and cars. And then the final type of tax is estate tax, and estate tax is triggered by an individual passing away. So out of these 5 different types of taxes, we're going to focus on the 3 that are in the green ovals: income tax, capital gains tax, and estate tax. And we've basically arranged this presentation to cover each of those 3 specifically. And before we get too far in, I should mention that, of course, we're covering this material via phone, but to the extent that you can get a computer in front of you, if you haven't done so already, I would encourage you to do that, because we're pulling the slides up and walking through them along with the presentation. So I think you'll be able to get a lot more out of the presentation if you have the slides in front of you that are accessible through GoToMeeting. So first off, we'll cover the new Tax Act. So as I mentioned, a good bit has changed tax-wise from 2017 to 2018. And I think some donors and people in general are aware of that, but I don't think everyone's aware of the specifics. So our philosophy has been that for people who give recurring gifts periodically, this probably hasn't driven much of a change. But as we get to the end of the year, we do think that this could cause some change in donor behavior as people look at their tax situation once they're getting close to the end of the year. And I think furthermore, we'll really see more impact in 2019 once people have completed their 2018 tax returns and they get some perspective on how the changes in tax law impact them specifically. So within this particular section, we're going to talk about the Tax Cuts and Jobs Act, and we'll refer to it on future slides as TCJA for short. One of the key things that's happening in the new Tax Act is we have changes to the tax rates and then to the income ranges to which those tax rates are applied. You may, when we use the term income ranges, many of you have probably heard the term tax brackets. So the dollar amount of income that goes into various tax brackets is changing along with the tax rates that are applied to those brackets. One of the big changes that's really impactful for giving is an increase to the standard deduction amount. So we'll talk about this in more detail, but when you look at itemized deductions, which are items specific to you, such as charitable giving, different type of taxes that you may pay, and some other items, you evaluate the sum of those versus your standard deduction for an amount that you'll use to reduce your taxable income. So that standard deduction amount has nearly doubled, which means that you have to have a lot more itemized deductions to be able to clear that standard deduction bar. We'll see some examples of that in the presentation. Other changes coming with the new Tax Act are that you now have a cap on some different type of itemized deductions. So previously, you could deduct any state income taxes or local income taxes that you pay. You can deduct any state or local sales taxes that you pay, and then also if you have property-related taxes. So you could previously combine all those and use those all as itemized deductions, but now they're all thrown together and a $10,000 cap is applied. So the standard deduction amount is increasing, but these items that were itemized deductions are now capped as well, which means that it's harder from another perspective to clear that standard deduction amount. Furthermore, there were some deduction items previously in place that are now gone. And I'll also mention that the previous tax law included exemptions. So an exemption was a per person amount by which taxable income could be reduced. Those exemptions have gone away. And then one of the other key changes is, with some subtleties which we'll cover, an individual could get a tax deduction for up to 60% of his or her adjusted gross income via charitable donations. Or excuse me, that limit was 50%. Now it has gone up to 60%. So that's actually a positive, perhaps in a small way, but still a positive for charitable giving. So some of the potential impacts that we see through the new tax regulation. So overall, most people will pay less in income tax in 2018 relative to what they did in 2017. So if I'm paying less in taxes, then more of my paycheck ends up in my pocket and I have more capacity to give from current income. So we think that's a positive for current gifts. There's also a higher standard deduction. And this is something that's got some of us in the charitable giving community a little bit scared. We'll see how it plays out again once we see what people do at the end of 2018 and once they see their 2018 tax return. But there's concern that because donors will generally receive less tax benefit from making charitable gifts, that they may make fewer charitable gifts. And then finally, that limit of your adjusted gross income that you can deduct in any 1 year, with that going up, you can get more of an immediate tax benefit from large gifts. So that's a positive. So now we'll move on to income tax. Income tax is one of the primary forms of tax that people pay. It's the tax I think people focus most on. So something that's really important to know as we talk to donors. So the key topics that we'll want to cover here will be tax brackets. And again, we mentioned that a tax bracket is a range of income to which a tax rate is applied. We'll talk about how we calculate income. So there are different phases of income, and we want to make sure that we have our terminology precise and that we know how to calculate these types of income. And then finally, we'll talk about deductions within this section. So deductions are really important because charitable giving is a deduction item. So for a short overview of our federal income tax system, obviously there are tens of thousands of pages in that, but for right now we want to focus on just one of the highlights, which is that our federal income tax system is what's called a progressive tax system. And essentially what that means is as you have higher levels of income, you're going to pay a higher tax rate on average. So of course, as you have more income, you're going to pay more in dollars of tax, but your tax bill as the percentage of your income also will go up the higher your income is. So how does that happen? Well, that happens through tax brackets. And all a tax bracket is a range of income that has a tax rate applied. The overall point here is that higher tax rates get applied to higher income ranges. So we'll look at those tax brackets here. And so everything that we're going to be talking about in this presentation is based on the married filing jointly tax status. So any numbers you see, that'll tie into married filing jointly That's obviously going to be the case for many major donor entities. These numbers would shift depending on if you're talking about a singular filer as well, though. So with this table, we have different ranges of income, and then a tax rate is applied to that range. And so one of the key things that I want to point out here is a common misconception about tax brackets is most people believe that when you have income that gets to the next level, that all of your income is taxed at that highest rate. So for example, we see the first income range is $0 to approximately $19,000. So, and a 10% rate's applied there. What many people think about tax brackets is if, say, someone has $20,000 of taxable income, then all $20,000 of that is taxed at a 12% rate. So that's actually not correct. Only the dollars above $19,050 are taxed at the 12% rate, and the first $19,000 approximately is taxed at 10%. So when we talk about the highest level of tax that you pay, that's called your marginal tax rate. And another way of thinking about that is the next dollar of income you earned is going to be taxed at that next highest rate, which is the marginal rate. And then if you were to have a deduction, the pennies on the dollar that you save in your tax bill, that's based on your marginal tax rate. So when we look at this table for 2018, there are a couple changes from 2017. Generally, these income ranges have moved larger, and that's a good thing. And in most cases, the tax rates have moved down. So say, for example, under the 2017 tax table, the highest tax rate would kick in at a little over $400,000 of taxable income. Now, for someone to be in the highest tax bracket, a couple would have to have over $600,000 of income. And furthermore, the top tax rate previously was 39%, now it's 37%. So we don't have the 2017 table presented here because that's kind of in the rearview mirror, but generally this 2018 tax table will be more favorable for people than was the 2017 tax table. So that's the key way that people are likely going to save on their tax bill in 2018 relative to 2017. So when we looked at those income ranges on the table in the previous slide, those income ranges were related to taxable income. So we need to make sure we define what is taxable income. And taxable income is more than just your paycheck, but it also has items that reduce your income. So let's look at, actually, let's talk first about some of the items in taxable income. So your paycheck certainly counts. Again, if you've got income from investments like interest and dividends, that's included in your taxable income. If you've got income from, say, rental properties, from business interests, etc., that all flows in. You have some reducing items as well, so that can be the standard deduction or your itemized deductions, depending on how you file your taxes. So when we talk about taxable income, really our starting point for getting to that number is adjusted gross income. So what we've listed in the table here are a number of items that get you to adjusted gross income, also called AGI for short. So we mentioned wages, investment income, business income. If we generate capital gains and losses, that will be adjusted gross income. And there's some other things that I think are a little bit more interesting in terms of your AGI. So if you receive Social Security benefits from the government, they actually tax you on that, which feels a little bit circular to me, but that's the way it works. Another one that's kind of interesting is tax refunds. So if you file your tax return and you've withheld more tax in the year than what you actually have as your final tax bill, you'll of course receive a tax refund. But then the following year, the government taxes you on that tax refund. Another item that seems kind of circular to me, along with unemployment benefits. So the theme here is a number of different items go into adjusted gross income. There are a few items that reduce adjusted gross income. So these are not tax deductions. These are items that specifically reduce AGI. The most common one is the one in the upper left-hand portion of the table, IRA contributions. So there are some income levels where you don't get an AGI reduction for contributing to an IRA, but if you're below a certain amount of income, you basically reduce your taxable income or your AGI by the amount of that IRA contribution. So there are some things that can bring down that AGI number. And again, getting back to taxable income, we started with adjusted gross income and calculated that number. The good news now is we, from here, only subtract items for getting to our taxable income. And as we're highlighting in that green box, generally, individuals are going to be taxed on a lower base than all of their income. So generally, people are going to be taxed on a lower number than the AGI. The AGI is the starting point in the higher number, and then we get to deduct more items for getting to taxable income. The key concept really here is really deductions. And deductions are very important for charitable giving because charitable giving is a deduction item. So when I'm looking at deductions as a taxpayer, I have two choices here. One is that I can choose to take the standard deduction, which is a flat number that's the same for everybody. The other option I have is to itemize my deductions. Itemized deductions are events specific to me. I basically aggregate all those, and then I compare those to my standard deduction amount. So if the sum of my itemized deductions is larger than the standard deduction, I want to itemize my deductions because that allows me to reduce my taxable income by a larger number. So under the old tax law, about 70% of people would take the standard deduction. And you really have two main motivations for using the standard deduction. The first one we've already talked about, which is it's going to reduce your income by a larger number and therefore bring down your tax bill by a larger number. That's a great thing. The other reason why you might choose to take the standard deduction is because you don't want to hassle with maintaining all of your itemized deductions and then reporting them. So there's a simplicity element. Under the old tax law, about 70% of people would go the standard deduction route. But based on the new tax law, the standard deduction is even higher, and some of the deduction items are eliminated or suppressed. So the expectation is that about 95% of people will take the standard deduction. And that's really important. And the reason that's important is what we highlight in the green box on this slide. Because if you want to get a tax benefit from charitable giving, you have to itemize your deductions. If you're using the standard deduction, you don't get a tax benefit from your charitable giving. So for your donors that are very tax-minded, that's going to be a little bit of a challenge. However, we also, of course, hope that our donors are passionate about our mission. So the standard deduction amount for 2018 is $24,000 for a couple that's married filing jointly. As a point of comparison, for 2017, it was $12,700. So the standard deduction has nearly doubled under the new tax law. So now that we've covered the standard deduction, let's talk about itemized deductions. So again, our decision is standard deduction versus itemized deductions. And the key concept here is if we add up all of our itemized deductions and they're larger than the standard deduction, we would choose to itemize. So here's some examples of itemized deductions. Charitable gifts being the one that's most relevant to us. For people with a mortgage, the mortgage interest is tax deductible. State and local taxes are tax deductible. Property taxes are also deductible. And then the remaining three items, medical expenses, investment interest paid, and casualty losses in a disaster event are less common, but ones that are still out there. So as a reminder, if we looked at this list for 2017, it would be a little bit longer. Some deduction items have been eliminated. And like we talked about earlier, your state and local taxes and your property taxes are grouped together and they're capped at $10,000. Previously, there was no cap. So that makes it harder for people to itemize. One thing we're going to do in this presentation is not just lay out information, but give examples, because I think seeing the numbers and seeing how some of this plays out makes these concepts much, much more tangible. So we've got our first example here, and that's going to be around deductions. So in this example, we're talking about a couple that's married filing jointly. Again, all the numbers we see, all the examples will be that scenario. And they have about $200,000 of adjusted gross adjusted gross income. AGI is the number that's pre-deductions. And so they have a handful of items that they'd be eligible to itemize. They gave $15,000 in charitable gifts. They had $8,000 in interest on their home mortgage, and they paid $6,000 in state income tax. So we have the question, should this couple take the standard deduction, or should they itemize their deductions? The standard deduction for a couple that's married filing jointly is $24,000. That number is going to be the same for everybody. So that number, hence the name standard deduction, is in fact standard. The sum of their itemized deductions is the sum of those three items we laid out. The $15,000 in charitable giving, the $8,000 in mortgage interest, and the $6,000 in state and local taxes. So when we add those up, that comes to $29,000. So what we see here is that the itemized deductions in total are larger than the standard deduction. So when you see that being the case, then that points you towards the couple should itemize their deductions. Essentially, they have itemized deductions $5,000 greater than the standard deduction, which means they can reduce their taxable income by $5,000 incrementally relative to taking the standard deduction. So we talked about, just covered an example for deductions, and so we're going to tie both deductions and income tax together for 3 examples here. So these will help kind of bring the previous 2 sections together. The first of our 3 examples here is the most simple. It's a married couple that has $75,000 in adjusted gross income, and they're paying $2,000 in state income taxes. They're interested in writing a gift annuity contract that has a present value of charitable interest of $10,000. So when you see the phrase present value of charitable interest, you can kind of really simplify that a little bit and say the deduction they would potentially get is $10,000. So here we're asking the question, what's the potential deduction from doing the gift annuity contract? So in this case, they have the standard deduction of $24,000, as everyone does. And their potential itemized deductions are $12,000 in total. $2,000 from the state taxes, $10,000 from the gift annuity contract. So when we compare those 2 numbers, the itemized deduction amount is lower. Therefore, the couple should take the standard deduction. And when the couple takes the standard deduction, they don't receive a tax benefit from doing the gift annuity. So it's absolutely fine for the couple to take on the gift annuity contract. They just won't receive an income tax deduction for doing so because they're not going to itemize their deductions. So our second example will get a little bit more complex than the first. Again, we've got a married couple that has $225,000 of taxable income before we consider any potential deductions. This couple paid $10,000 in state taxes and $15,000 in mortgage interest. Both of those are potential deduction items, of course. And the couple is considering a donor advised fund contribution of $18,000. So what's the potential tax impact there of the contribution? So we'll do the same thing that we did in the previous example. We'll sum up the deduction items. That'll be the taxes and the mortgage interest plus the potential donor advised fund gift, and that all adds up to $43,000, which is of course larger than the standard deduction of $24,000. In that case, the couple should itemize and not take the standard deduction. The taxable income the couple has before doing the donor advised fund is $225,000, as we laid on in the previous slide, minus the other 2 potential deduction items they had, which represents $25,000. So they've got $200,000 of taxable income before doing the donor advised fund contribution. That puts them in the 24% tax bracket. Otherwise said, for every dollar this couple can deduct, then 24 cents of tax avoided ends up in their pocket. So when we look at an $18,000 donor advised fund contribution and we apply the 24% marginal tax rate, then the tax savings to the couple is about $4,300. So, the couple is interested in making a gift to charity, and they can save about $4,000 in their ultimate tax bill by doing so. So again, great outcome for the donors. Our third example adds a little bit of complexity as well. So this is a married couple that is a very high earning couple. They have $900,000 of taxable income before deductions are considered. And they've got $100,000 of existing itemized deductions before we consider any charitable giving. This couple has some assets that they'd like to donate into a charitable trust, and the potential deduction that they would get if they decided to enter into that charitable trust arrangement would be $150,000. So what's the tax impact there? The potential itemized deductions total $250,000, 100 existing plus 150,000 from the charitable trust. That obviously far exceeds the standard deduction, and therefore the couple should itemize. When we look at the couple's taxable income before undergoing the trust, $900,000 minus the $100,000 of deduction items before the charitable trust. So they have $800,000 in taxable income, which puts them in the top tax bracket, 37%. So every dollar of income they earn incrementally is taxed at 37% rate. And then any tax deduction item means 37% of tax avoided ends up in their pockets. So the couple decides to move forward with the trust at $150,000. That's their deduction amount. And then a 37% tax rate is applied to that deduction, meaning the tax impact is a little bit over $55,000. So again, a great outcome for this particular couple. They've been able to make a gift for charity. They'll receive an income stream from the charitable trust, and they save $55,000 in taxes paid. All right, now that we've covered income tax, we'll talk about capital gains tax. So the key topics that we want to cover for capital gains are first, cost basis. And whenever we calculate capital gains, essentially our capital gain amount is what we're selling an asset for minus our cost basis. So it's really important to know what our cost basis is. The second key topic we'll look at is the holding period. So whether you've held an asset that you sell short-term or long-term, that has an influence in how it's taxed, at what rate it's taxed. So an overview of capital gains. As I mentioned, a capital gain is the result of selling an asset for more than you paid for it. And there's some potential adjustments there. Capital gains are considered taxable income. So when we were talking about income tax and we looked at that tax table of different income ranges and rates, capital gains are fed into that tax table. But potentially, capital gains can be taxed at lower rates than ordinary income is taxed. And we'll look at the scenarios where that plays out. So our cost basis calculation, as I mentioned, it's essentially cost basis is what you paid for it with some potential adjustments. And there are really three components here. The first is what you paid for it, and that one is essentially locked in. And the other two items are conditional. So if you've made what's deemed a capital improvement to your asset, that actually increases your basis. And if you've taken these accounting concepts of depreciation, amortization, or depletion, that will reduce your basis. So what we want to have as people potentially selling an asset is as high of a basis as possible. So if we're subtracting a large number, then our remainder is going to be relatively small, and that's a good thing because the tax is applied to that remainder, otherwise called the gain. Here's some other notes on cost basis. For the most part, we're considering assets that we've bought or built, but there are a few other scenarios, of course, through how we can acquire assets. One of those is through a trade. So if we trade away an asset or acquire another, then the basis we have in the new asset that we've acquired is the same as the basis in the asset that we traded away. So you're essentially rolling over your basis as you trade an asset. If we inherit an asset, the basis is the value of the asset at the previous owner's date of death. So let me stop for just a second and talk about that one because that's really powerful. Think about a case where an individual bought a stock 40 years ago, and as we'd hope, over the course of 40 years, the stock has increased in value significantly. So if that person were to sell the stock, he or she would probably have a pretty large tax bill. There would be a large gain there. But if that stock is held until death, the person who inherits it gets what's called a step up in basis. So say, for example, the stock is purchased at $20,000. At the original owner's date of death, it's worth $100,000. Then the person who inherits that stock actually has a basis of $100,000 in the stock, and therefore can sell it that same day and not generate a tax bill. That's a really powerful thing. And then if an asset is acquired as a gift, the receiver basically has the gift at the same basis that the giver had the asset at. Let's go through an example of cost basis. So this is one with a rental house, and the house was originally purchased 5 years ago for $100,000. Since that house was purchased, the owner has added a garage at a cost of $15,000. We're going to deem that a capital improvement. Say for a rental property, something like painting the house isn't going to be a capital improvement. That would be an expense item. But building on an addition would be a capital improvement that adds to the basis. And then the house has been depreciated by $4,000 per year over the course of 5 years. So when we calculate the basis, we start with our $100,000 purchase price. Remember, basis is what you paid for it, plus or minus some other adjustments. And so one of our positive adjustments to increase basis is that capital improvement, $15,000 for the garage. And then we subtract $20,000 from the basis for the depreciation that's been taken to the tune of $4,000 for each of 5 years. So the total of those items is $95,000 in cost basis. If the owner of that rental property were to sell it for $120,000, he or she would have a capital gain of $25,000. $120,000 sale price minus $95,000 in basis. And that $25,000 capital gain is put into the person's taxable income and is subject to capital gains taxes. So let's talk about the holding period. So the cost basis determines what amount is taxed. The holding period determines at what rate that amount is taxed. We have only 2 holding periods here, so it can be relatively simple. The first is short term. So if an asset's been held for 1 year or less, it's deemed short term. If an asset is long term, it must be held for more than 1 year. So it's not 1 year, it's 1 year and a day. Hopefully not many of your cases with donors come down to something happening on a specific day, whether it's a year plus day, but keep in mind that it's 1 year plus day to be long term. So why is that relevant? Why is short term versus long term relevant? Again, it's based on, or it influences the tax rate that's applied to the gain. So if something is held short term, a year or less, then it's taxed at an ordinary income rate. So there's really no benefit, incremental benefit from selling something that's short term relative to your ordinary income rate. Basically, it's thrown into your ordinary income and taxed at the rate per your marginal tax rate. Long-term capital gains are a little bit different beast. So long-term capital gains have a unique tax schedule. As you can see, if someone's taxable income is $77,000 or below, there's actually no tax on the capital gain. And if it's in the range of $77,000 to $479,000, a 15% capital gains rate is applied, and then a 20% capital gains rate applied for taxable income amounts over that. Keep in mind that this table is talking about not just the capital gain generated, but the person's whole taxable income. And the key takeaway from this table is that in almost every case, a long-term capital gain will be taxed at a lower rate than will the person's ordinary income. We've made notes of a couple other cases here, a couple other factors. One of the things to point out is in that note 1, for couples that are marital filing jointly who have adjusted gross income over $250,000, they also pay an additional Medicare surtax of about 3.8%. So for folks in higher AGI levels, they'll actually pay higher capital gains rates than what you see strictly based on this table. As we want to do with each of these portions, we're going to go through a couple examples of long-term capital gains. So the first of those is a stock that was purchased 5 years ago for $100,000. So that stock has appreciated since then, and it's now worth $150,000. The donor overall has $180,000 in taxable income. So we want to look at here, let's compare the tax impact of selling the stock as a first step and then giving the proceeds away to charity as a second step versus just giving the stock directly to charity. So we have two options here. Option 1 is sell the stock, give the proceeds to charity. Option 2 is give the stock directly to charity. Under the first of those options, when this particular person sells the stock, he or she generates a capital gain of $50,000, and that gain is taxed at a 15% rate. So the person now picks up a $7,500 tax bill. However, through that donation, and we're going to assume that the donor has already cleared the standard deduction, the donor can save on taxes by itemizing. And the person who has $180,000 in taxable income, as we saw in the previous slide, has a marginal tax rate of 22%. So essentially there we're taking the gift amount times the marginal tax rate. And this particular donor can save $33,000 in taxes. That's, a nice thing. So what's the net impact of that? Well, the donor picks up $7,500 by selling the stock, but then reduces the tax bill by $33,000 from getting a deduction on the gift. So on a net basis, that's a tax savings of a little over $25,000. That's a nice thing, but there's a better way to do that transaction. Option 2 is to give the stock directly. By giving the stock directly, the donor bypasses capital gain. So a donor can give stock that's been held for that 5-year period and dodge paying tax on the gain and still get that same deduction amount of $33,000. So when we look at the net impact there, that's just pure savings. It's a $33,000 tax savings as opposed to a little over $25,000 in the previous scenario. So as you're looking at donors and their financial perspective or their financial picture, where you see highly appreciated assets, those are great ones to talk about giving because they can save a substantial amount in taxes by avoiding the capital gains there. Really impactful part of making large gifts and planned gifts. So we've got another long-term capital gain example. So this is a couple that has $300,000 in taxable income before capital gains are considered. They've got a piece of land, let's just assume this is raw land, that they've held for a long period of time. They bought it for $200,000 and now it's worth $800,000. They're going to sell that land for its current market price of $800,000, and that will trigger a $600,000 long-term capital gain. Obviously a very large gain, and that gain is twice the couple's level of taxable income otherwise. So what are the consequences of that? The first consequence is that the couple now has $900,000 in taxable income. Let's assume that this couple's income otherwise has been relatively stable over the years, and the couple's used to having $300,000. Well, having $900,000 can produce a little bit of a shock because, as you see on the second major bullet, their marginal tax rate, i.e. the tax bracket that they're in, previously has been 24%. Now they're all the way into that top tax bracket at 37%. So their marginal tax rate has increased significantly, and much of their long-term capital gain is going to get taxed at 23.8%, which, like we mentioned, is the 20% rate plus that Medicare surtax. So that's not necessarily going to be something that the couple's thrilled about. They're not likely used to this level of taxes. And so this is when you see something like this, a donor who wants to exit / sell an asset that they've held for a long period of time and has a very large gain, this is a great opportunity. There's a type of transaction called a zero tax sale. We'll get more into this at a later module, but a zero tax sale is essentially a means of gifting a portion of the asset such that the capital gains tax can be offset. That's another great outcome for donors. Basically, they can give part of the asset to offset the tax. A couple other capital gain notes, and this is on donating capital gains items. So if one donates a long-term capital gain property, remember that's if they've held it for more than a year, they can take a deduction in the year of gift that's up to 30% of their adjusted gross income. So if there's a couple or individual that makes a really large gift relative to their income, they actually won't be able to deduct that full amount in the year of gift. The good news is that unused deduction amount can roll forward for up to 5 years. So even if the deduction can't come in year one, it can be used later on down the line. If a donor is giving property other than long-term capital gain property, that threshold increases up to 60% of income, and it can be carried forward 5 years as well. So as a small note there, that 60% number, as we talked about, was 50% in 2017 and prior years. So if donors are looking to give non-long-term capital gain property, they can actually do so to a larger degree and take the deduction all in year one. All right, our third section here is estate tax. Estate tax, again, comes from the event of someone passing away. This is something that really won't be a major factor with very many of your donors will see, but avoiding estate tax can be a key motivation for some individuals. The key topics that we'll cover will be looking at the size of one's estate. And another way of saying estate is essentially the assets that one has when he or she passes away. We'll look at the estate tax when we're talking about a married couple. There's some interesting factors there. And then we'll look at estate tax rates as well. So an overview of estate taxes. Essentially, an estate tax is a tax on property transferred to heirs when one passes away. Many people call the estate tax the death tax. And while I think they say that a little bit tongue-in-cheek, I actually think that's a great description because passing away is the event that triggers estate tax. So like I just said, not many people will have to face the estate tax. Someone has to have a very large estate for that to be a factor. And from what I've read, the estimate is only about 0.1% of states will actually face the estate tax. And I actually think that number could be a little bit lower even than just 0.1%. So what's the threshold for estate tax? Each person has an exemption of 11 million, roughly 11.2 million. And what the exemption means is the first $11 million of assets someone has basically can be thrown out for estate tax purposes. So say someone passes away with $10 million in assets, which is of course an extreme level of net worth, then estate tax doesn't even come into play. There's also a mechanic where that amount is essentially doubled for married couples. So if you're talking about a married couple, then we're now looking at 22 million in assets. So one of the things we want to pay attention to is how has that changed versus 2017? So the Tax Cuts and Jobs Act really influenced the estate tax because that exemption amount was $5.5 million per person. So just like the standard deduction amount, the estate tax exemption has effectively doubled from one year to the next. And the consequence of that is a lot of people are taken out of having to worry about estate tax. Let's talk about the married couple mechanics because it's maybe slightly complex, but I think it's really worthwhile to at least be aware of. The first item is that there is an unlimited marital deduction. What that means is that the first spouse to pass away can transfer property to the second spouse, the surviving spouse, to an unlimited degree without tax. So we've looked at numbers 11 million, 22 million, but if the property is passing from one spouse to the second, an unlimited amount of an unlimited amount of property can move from the first spouse to the second spouse. And then in addition to that, the estate tax exemption is portable. So what that means is the first spouse passes away, moves the property to the second spouse, no estate tax implications there. And the first person to pass away can move that exemption to the second. So when the second person passes away, that $22 million combined exemption is available. That's really powerful. Essentially allows a doubling of the exemption. So next up, we have the estate tax rates. And if this table looks long and particularly onerous to you, well, you and I are in the same boat. This table only applies to amounts above the exemption amount. So this table only kicks in for couples when the size of their estate is over $22 million. Now, why do we care about $10,000 and $20,000 increments when we're already above $22 million? I have no idea. Seems kind of silly to me. But if you think about it, most estates that are over $22 million will be over $23 million, which is basically the highest tax rate, and you can see that at the bottom of the table. So I think as a means of shorthand, generally we can think about for cases where the estate tax does apply, you can think about it being at a 40% rate because, once you're at 23 million, then it's at the 40% rate, and if you're below 22, then it doesn't kick in at all. So here's an example of the estate tax. We've got a couple with a very large estate. The second spouse passes away, and the size of the estate is $40 million. That option to move the first spouse's exemption of $11 million to the second spouse is used. That's something that you actually do have to elect to do on the first spouse's tax filing when he or she passes away. It doesn't automatically happen. And part of this couple's assets is an apartment complex that's valued at $6 million. The second spouse wants for the children to have ownership of that apartment complex and to be able to manage it. Let's say there's some special emotional tie with this particular asset. That last bullet point is something that essentially is a more detailed note to make sure the example is valid. We won't get into that in detail. But when we look at the size of the estate over the exemption, so it's a $40 million estate, and the exemption is $22,400,000, that means that there's an additional slightly over $17.5 million that's subject to estate tax. And when we apply that $17.5 million to the estate tax table that we saw a couple slides ago, that means that this estate will be assessed for $7 million in estate taxes. That's pretty painful. So this is something that we can cover in a future module in more detail, but there's a type of charitable gift called a charitable lead trust that can get an asset back to heirs with the delay, and it can create a deduction for estate tax purposes. So essentially what a lead trust aims to do is it's typically set for a certain number of years, and in each year a distribution goes to charity. And then at the end of the trust period, the assets revert back to non-charitable beneficiaries. So in this particular case, the second spouse could create a charitable lead trust for, let's say, a period of 10 years. A certain percentage of the trust market value can go to charity over that 10-year period, and then the apartment complex can return to the children. So, and in the process of doing that, there's an estate tax deduction created to try to whittle down that $7 million potential tax bill. Okay, so we are in the home stretch here. This is our last section, and it's taxation of investment accounts. So there can be some implications for giving different type of investment accounts. There's some types of investment accounts that probably make pretty good gifts because They can cause some tax challenges for the donors and their heirs as well. So we'll cover that in this section. The key topics that we'll go through will be interest and dividends. We'll talk about IRAs, individual retirement accounts, and 401ks. And then we'll also cover deferred annuities for just a second. So how are interest and dividends taxed? Interest is taxed as ordinary income, which essentially means it's going to get taxed at your marginal tax rate, i.e. the tax bracket that you're in. Interest doesn't really have any favorable tax element to it. And when we talk about interest, think about bonds and think about if you do have a bank account that pays you any interest, which fortunately these days some of them actually have started paying interest again. But that essentially is taxed just like income that would be from income from your employment. And then dividends, essentially by default, are taxed as ordinary income unless the dividend is a qualified dividend. The good news is that a lot of dividends are qualified dividends. Just for the sake of clarity, we've defined qualified dividends here. So a summary of the qualifications are that it has to be an American or qualifying foreign company paying the dividend. And then there's a rule on how long that you've held the stock or the mutual fund around the dividend payment date. This qualification of 61 days and the 121-day period around it, a little bit complicated, but essentially you can think about that as if there's a donor who has held the stock for an extended period of time, he or she is going to have that dividend become a qualified dividend. So why is it important to be a qualified dividend? Well, qualified dividends get taxed at long-term capital gains rates, which as we saw in the long-term capital gains tax table, almost always will be taxed at a lower rate than one's ordinary income. So if you have to take your pick between receiving interest and receiving dividends, generally you're going to want to receive dividends just based on the tax factors alone. Obviously, there are other investment merits involved. Let's look at IRAs next, because IRAs, I think, can be really good assets to give. So when someone makes a contribution to an IRA, again, individual retirement account would be the full spelling out. Those contribution amounts are excluded from someone's adjustable gross income. Another way of saying that is if there's a person who makes a contribution to an IRA, he or she in many cases can basically reduce his or her income by that amount and therefore pay a lower tax bill. The limit on what you can contribute to a traditional IRA is $5,500 per year or $6,500 if you're over 50 years old. Like I just mentioned, there are some limits on being able to contribute and have that offset the amount of taxes you have to pay. So if your employer has a retirement plan like a 401k or a 403b, then your ability to reduce your tax bill gets phased out starting with about $100,000 in income. Otherwise said, if you have an individual, let's say for example, who has $150,000 in income, he or she doesn't get that tax benefit from contributing to an IRA. And then there's a higher limit if your spouse has a retirement plan. How are IRAs taxed? So there's some, again, this gets to why is an IRA a good asset to give? Well, you can save on taxes up front, but when you withdraw money from your IRA, that all gets taxed as ordinary income. So it doesn't get taxed at, say, a long-term capital gains rate. It gets taxed at the higher ordinary income rate. And during the calendar year in which you turn 70 and a half, the government essentially requires you to start pulling money out of your IRA. Now, for those of you who are approaching age 70, start to pay attention to your half birthday. You can celebrate that you now have to take one of these distributions. Why it's 70 and a half and not just 70, I have no idea, but that's how Congress has said it. So essentially, the government forces you to take money out of your IRA once you get to a certain age, because that's then taxable to you and, of course, tax revenue to the government. And that amount of the required minimum distribution as a portion of your IRA's value increases each year. The thing to keep in mind with traditional IRAs is anything can happen within the bubble of the IRA. You can receive interest and dividends, you can sell assets and generate capital gains. There's no tax impact there. You only pay tax when you pull money out of the IRA, but that money is taxed at an ordinary income rate. So let's talk about inherited IRAs as well. And we're going to think about this from the perspective of not a spouse inheriting the IRA, but let's say children. So if an IRA is inherited, those required minimum distributions start not triggered by age of the person inheriting the IRA, but they start automatically just by the event of the original account holder passing away. So the person inheriting the IRA has to begin to take distributions based on his or her, the inheritor's lifespan. For that to be the case, to be able to stretch that out over the inheritor / younger person's lifespan, the person who passed away has to be 70 and a half. You have to make that election, so it's something you have to do to stretch it over the inheritor's lifespan. If you don't do that, the IRA essentially has to be cleaned out within 5 years. So, as I've been laying that trail of breadcrumbs along the way, an inherited IRA is a really good asset to give away in an estate plan because it forces taxable income to the person inheriting the IRA. So it's great that you get income, but it also forces a tax bill on the inheritor as well. Let's spend just a second on Roth IRAs as well. So when we talked about a traditional IRA, you save taxes up front and you pay later. A Roth IRA is the opposite. So you don't get any tax benefit on day one of putting money in a Roth IRA, but when you pull out money down the line, you don't pay any tax on it. So the contribution limits work just like they do for a traditional IRA. And then you also have an income level where you can no longer contribute to a Roth IRA based on the status of a retirement plan. As I mentioned, with Roth IRAs, you don't pay any tax on pulling the money out. Anything that happens within the Roth IRA is not taxed as well. And then one of the other nice things is you have total flexibility in terms of pulling money out of the Roth IRA. There's no required minimum distribution. And even if there were, it's not taxable anyway. 401ks, we'll spend just a second on this as well as we wrap up. A 401k is a lot like an IRA, but an IRA is something that the individual sets up. A 401k is sponsored by the employer. The contributions to a 401k are excluded from income, just like what's the case for a traditional IRA. Those limitations of what you can contribute are much higher in a 401k plan, $18,500 per year, or $24,500 if you're over 50. And then, of course, many employers will match some degree of 401k contributions, but there's a limit as to what the employer can match. So how's that taxed? How are 401k transactions face taxable income? So withdrawals, just like they are with traditional IRAs, are taxed as ordinary income. You do have some more flexibility on required minimum distributions, but if you've retired by the age of 70 and a half, you do have to take RMDs as well. And then just like with an IRA, anything that happens while it's still within the 401k is not taxable. So a couple of notes here. An individual can roll a 401k into an IRA. That may be required by an employer if the employment status has been terminated. If an IRA, or excuse me, if a 401k is inherited, it's got to be withdrawn by the heirs within 5 years, unless it's rolled into a 401k. So again, a 401k is a lot like a traditional IRA, and it's something that can force taxable income to heirs. That's another good asset to give. A couple of slides here on deferred annuities, and then we will see if we have any questions. For deferred annuities, it's essentially a investment vehicle and an insurance vehicle to delay payments or income until a future date. Investment earnings grow tax deferred within the annuity. and then growth within the annuity gets taxed as ordinary income upon withdrawal. So those elements are ones that look like a traditional IRA and a 401k as well. So for a quick example, if an individual put $50,000 into a deferred annuity initially, it's grown over time to have a current value of $150,000. There's essentially $100,000 of embedded ordinary income within that deferred annuity. So we calculate that by taking the current market value of $150,000 and subtracting the contribution amount, initial contribution of $50,000. As we get to questions, let me pull up our disclaimer. That disclaimer says we're presenting this material for informational purposes only, and please don't consider this presentation to be tax advice. I'm going to pull up following here to see if we have any questions. If you do have a question, feel free to submit that in the chat box right now. At present, it looks like we don't have any questions, so feel free to type something if you have it. One thing we also, I think, want to make sure we talk about is what's called bunching of charitable gifts. So when we go back to that concept of standard deduction versus itemized deductions, the standard deduction is a much higher bar to clear now, and many donors won't get a tax benefit for making the type of giving that they have always gotten a tax benefit from giving. So one way around that is to create a donor advised fund and place essentially what would represent multiple years of charitable gifts into that donor advised fund at once. That allows you to get a tax deduction in year one for what ultimately will be multiple years of gifts. That'll help you clear the standard deduction bar. And then, of course, the donor can make requests for gifts over time to grant that money out of the donor advised fund to the end charities, just like the donor would do with the charitable giving that he or she's been doing anyway. Ray, any other comments or thoughts you wanted to have? I don't think we have any questions.
No, I think that's it. Could we open it up maybe and see if they've got
Sure.
any questions?
Absolutely. All right, we're going to take a little bit of a risk here, and we're going to unmute everyone's line on our end. So if you do not have a question, please make sure that the phone's off mute on your end. So I'm going to take everyone off mute on our end in 3, 2, 1.
So as Winters is finishing up here, if anybody has any questions about any of the concepts that he's presented, you're welcome to speak up. Well, I guess we don't have any questions, so we're going to record this, and if you would like to have a copy of the recording, excuse me, do I hear somebody?
Maybe not.
We'll have a copy of the recording available probably next week. So if you'll send me an email, I'll be glad to give you access to being able to review this, or perhaps using it to train some of your other staff. And if you have any questions after you take a look at this or after we hang up, don't hesitate to call either myself or Winters. We're glad to take your calls anytime. So thank you guys very much, and God bless you and the ministries that you serve. And it's just our pleasure to work with each of you all. So thank you very much. We'll speak with you later.
Absolutely. Thank you all, and we appreciate it. This material is somewhat dry, but we've got more exciting things to come. So thank you all.
I think somebody was going to ask a question. Did I hear somebody?
That may have actually just been an echo of me.
Okay. Okay.
All right.
Okay. Have a good afternoon. Thanks, guys.
Thank you.